An hour ago, we had a really hot CPI print in America. A lot of that is traced back to the reopening theme that we can get into in just a moment. But from your perspective, as a company leader, a corporate leader in America and beyond, how do you navigate this increase in prices we're experiencing stateside over the last few months?
Yeah, absolutely. Good morning and nice to be with you all. Obviously, our company is performing very well right now, and a part of that is navigating some of the challenges from a cost perspective. The biggest thing we can do in order to manage that, candidly, is we invest in our brands and we invest in innovation. And by virtue of doing those things, we create products that consumers are willing to pay more for, and that allows us to take price increases that help us offset that inflation. So it's something that obviously all big companies are dealing with right now, and frankly, I think we're very well positioned to deal with it.
It's interesting when I have policymakers on the show, Hugh, when I have central bankers, Federal Reserve officials, they take this line that a lot of this is transitory. The bond investors do the same thing. When I talk to corporate leaders, I sense something a little bit different. How much daylight do you sense is between you and the policymakers making the calls down in Washington?
Well, we're always a little bit conservative on this front, right? So I'm not going to assume it's going to be transitory. I'm going to assume it's probably going to be around for a little while. And then we'll build our plans around that. If we happen to get surprised with inflation lowering itself more quickly, that's great. We'll adjust to that. But right now, I'm assuming it's going to be with us through the better part of next year.
We've heard some talk about sharpening cost management initiatives, Hugh. Does that mean cost cuts, or can you pass on a lot of this to the end consumer?
It's going to be both. I mean, as a company, we have a history of driving costs down. We announced this morning we're extending our productivity program through 2026 at north of $1 billion a year. And we've been taking out $1 billion a year plus since 2012. So we're always looking to run the company as efficiently as we possibly can, because we don't want to waste dollars in any direction. That said, when input costs increase, we're also going to take some pricing. We do it every year, and we'll do it again as we get to the fall of this year.
Hugh, my colleague Kelly Lyons went through the revenue mix of the company at the moment, where you're seeing growth and where we're seeing a bit of contraction as well. As we see the increased mobility in a place like North America here in the United States, how is that increased mobility translating into the change in the revenue mix over at Pepsico, Hugh?
Yeah, it clearly is moving more towards what we refer to as the out-of-home channels. So whether it's the food service, the restaurants and the like, and also convenience stores, mobility clearly drives those channels. At the same time, what we refer to as the take-home channels are actually still growing as well. So we're seeing good benefit across the board. The reason for that primarily is we made a decision last year that despite the pandemic, we were going to continue to invest in growth capacity. We were going to continue to invest in our brands. And as a result, now as consumers have come back, we're there ready to capture that business, and we're gaining market share as a result.
You and I talked about how sticky some of this consumer behaviour might be shortly after the pandemic and the lockdown when we reopened, Hugh. Are you finding out it is sticky? You're finding out consumers are snapping back to old themes, old habits?
Yeah, I think it's a little bit of both, in all candor. It's not an either-or type of thing. Clearly, as mobility comes back, they're back in the habits of sort of balancing out healthier eating and then the occasional treat or indulgence. The one thing that seems to be sticking a bit more is breakfast at home. That's a trend that I think people had sort of forgotten about breakfast at home pre-pandemic. They rediscovered it, and they discovered they liked it. So I think as we move to these more hybrid working models, breakfast at home will remain elevated. Obviously, our Quaker business was down in the second quarter, but on a two-year basis, it's up about 9%. I expect us to maintain some level of elevated performance versus where we were 2 years ago.
Hugh, just before I let you go, just one final question, if I may. I always enjoy having you on the programme because we get to go away from some of the core themes of the morning just for a minute or so. Let's do that right now. In the last week, the White House came out with an executive order on promoting competition in the American economy. And one of the themes, a couple of the themes that came out of that was this idea that consolidation is bad because it holds down wages and it leads to an increase in prices. I just wonder for your firm specifically what your message would be for the administration after they put that out.
Well, obviously, there was a lot in that executive order, and most of it I don't think has a substantial impact on us. The thing we're obviously always concerned about is having a level playing field and enhancing competitiveness. So to the degree that things do those two outcomes, we're happy with it. To the degree that it reduces the level of competitiveness, obviously that's something we'd be less happy with.